Hey traders, welcome to another video. In this one, we're going to be mainly looking at commodities, looking at some charts, looking at some prices, looking at some historical data, looking mainly during the 1970 to the 1980s and early 1980s, because that was when we saw our last major push for the commodities sector here. So moving right into it, why are we bullish on commodities? Why do we think that they will appreciate in the upcoming future? Mainly, it's due to the currency proliferation. Biden just proposed a $6 trillion budget to invest in infrastructure, education, healthcare, and more, which would, in his eyes, in his quote, would create really just a situation where America's, I don't know, very similar to Trump. He said, make America great again, or something along the lines of that, but pretty unbelievable. We were talking about 2 trillion earlier in 2020, and that was a big number, but 6 trillion is pretty unbelievable. But these numbers are just going to get bigger and bigger and bigger. It's kind of like a drug addict who is kind of needing drugs. If they continuously take that particular drug, they're going to need more of it to gain that same level of high, and that's what we're seeing right now. This is the US monetary base. This is basically the amount of currency that is in circulation. We've seen 2008, that was when they first started the QE, the quantitative easing, and that kind of started it all. Before that, we can see it was pretty steady. If we take it back a little bit, pre-2008, it's a pretty steady chart. We've seen some pretty big dips in 2000. Overall, it's pretty, I would say, sustainable looking. And then if we bring 2008 in, it gets pretty unbelievable. And then this is the new kind of 2020 COVID push that we've seen. And we're going to be seeing a far greater push here for the chart as the $6 trillion comes into the market. Pretty unbelievable. Going to get a little bit into the charts here. This is the prices of different commodities since January 2nd, 2020. Oil did take a major dump to the downside. Some of the charts actually went negative, like crude oil, US oil actually went negative. Brent did not. That was in the UK. But we have seen iron ore, soybeans, gold, copper are all appreciating quite significantly. We'll take a look at that within the charts that we'll take a look at in the next slides here. But overall, we do see commodity prices increase substantially, and we've seen this before. Now moving on to some of the charts, kind of looking at specific sectors. Everyone does understand, well, hopefully a lot of people do understand that wood and lumber has been appreciating quite substantially. And we see all the way from October 2019, it's been a pretty steady kind of sideways consolidation for, this would be pulp, paper, and allied products, so wood pulp. And we've seen from around 145, let's say 150 to be a little bit more conservative, all the way up to 204 where we are currently right now is a pretty substantial gain, and I don't think there's going to be any really end in sight for lumber products. A lot of people who might not really understand inflation are saying it's supply shortages and COVID's the main deal, where it does have a part to play. I think a large reason for this inflation to continue is going to be the currency proliferation that we are seeing. Now we're moving on to metals and metal products. This is going to be iron and steel. Similar sort of situation, different numbers on the y-axis, but overall we're seeing consolidation around 240 to, let's say, 180, 200, and now we are currently at 322. So another significant push for iron and steel. This is going to be for copper and copper products. We'll take a look at the chart of copper, which does look pretty darn bullish. And we can see right here, consolidating around 400 to 320, and we're currently at 502. And same thing with just overall construction materials. Price houses have gone up, and building a house actually has gone up in terms of the price, just because all the raw materials needed to actually create the house is substantially increasing, and we can see that within the chart right here. Not just raw materials for construction, but food as well is increasing in price. This is the price of corn, we can see consolidating between 180 and 140, currently at 231. And this is grains. This has been consolidating since 2015 within this range and finally has broken out to the upside, passing the 165 range, currently now at 225. So a massive push to the upside for not just the metals section, metal sector, but also food as well. Final thing we'll touch on is the soybeans. Similar sort of story where we're consolidating, and then during the late 2020, early 2021, we are seeing a massive pump in the prices here. Now let's take a look at a more broader perspective, looking at the overall commodities. This is the year to date that we're going to be primarily looking at, which would be right here. Crude oil up 42%, basically 43% from year to date. We see Brent crude, which is the UK, and then crude oil is US, 38%. Natural gas up 21%. Gasoline up 56%. Ethanol 71%. Some of these are pretty unbelievable. Some have not changed much. Like gold had its run a little bit earlier in 2020, back in the summer, and it has been consolidating on top of the previous all-time high at around 1900. We'll take a look at that when we look at the charts. Take a look a little bit more. Soybeans 21%, lumber 50%, just about. Some haven't moved a lot, but corn 40%. We can see if we take a look around 91, lithium, monster push, I think, because a lot of the people in the EV side do need lithium. So 91% just from the start of the year. Pretty unbelievable. I think at some point the EV companies might have to increase the prices of their vehicles just because the cost of lithium is absolutely going through the roof. Tin 51%. Not going to get too much into it, but we see overall the prices of most commodities are pushing up significantly. And it's not so much all commodities are adding value and getting so much more of a value add. It's more to do with the US dollar losing grips of being the world reserve currency, or at least being the dominant currency that people are utilizing to kind of compare different currencies, commodities, because the US dollar can move as well. Maybe some people might not know that, but it has moved for the DXY over 10% from the high that we've seen in the March 2020 COVID crash, which is a massive number if you're talking in terms of the FX markets, the foreign exchange markets. And this is the next thing we're going to look at is the CPI numbers, Consumer Price Index. Hopefully some people are taking a look at that. This is the global. You can pause it, take a look at it if you want, but we're going to be primarily looking at the United States. Their CPI numbers are finally actually ticking up at around 4.1% for the yearly basis. They've been fudging the numbers. I don't exactly know how many, but over the past 20 years or 25 years, they changed the formula for the CPI like 20 times or 15 times or something. So you can't really rely on the CPI, but the fact that it's actually showing a higher number than a lot of the first world countries within this list is signaling that the US could be entering a situation where there is high inflation, and with that they're going to have to raise interest rates. And we can see back in the historic inflation, we haven't seen much inflation for a very long time. This is, I believe, just for the year, because this is June of 2020, and kind of around the start of the year is when we started really seeing a surge in the CPI. And this is the CPI for the United States in the long term, all the way from 1955. We saw back in the early 70s all the way to the late 70s. There was a massive surge in CPI because there was a significant amount of inflation during the 70s. We're actually going to touch on that a little bit, but we first want to understand why there is so much inflation. Well, money printing, currency proliferation. Since 2008, 2009, as we can see within this chart, if we move to, let's say, like a 10 or 25 year, there has been basically zero interest rates or close to it for a very long time. We did try to have a little bit of a push up in inflation rates, but the stock market did collapse pretty drastically and pretty aggressively when they did. So at this point, they don't really have an option. The only way that they can really control inflation is through raising interest rates, but they don't want to raise interest rates because there's so many zombie companies utilizing the cheap or really free cash that they have to operate their business. Look at the Ubers, look at the Airbnbs, even Tesla. I'm sure if you follow the channel, you're familiar with a lot of the I guess you could say, zombie companies that are still unicorns. WeWork is another big one. And this is something that happened before. During the kind of late to mid 40s and until the mid 50s, after World War II, they did not want to raise interest rates because they had a lot of debt to pay because of the world wars. They kept interest rates very low at around 2%, the lowest it's ever been, dating back to 1790. So pretty unbelievable at the time, I'm sure, kind of similar to what we're seeing right now with negative interest rates. And what happened after? It takes time. Every action has a reaction, and this is what happened. Very, very low interest rates for decades, mid 40s all the way until like the mid 50s and on. From that point, they started seeing significant inflation come in, and with that, they needed to raise interest rates. And we saw you can't really just turn off and on inflation and the velocity of currency as quick as a lot of the Fed kind of talking heads are saying, in my opinion. It's not like they have complete control over the economy and the velocity of currency. You cannot control the velocity of currency, so it does ramp up and increase. They don't really have much to do other than try to raise interest rates to try to curb inflation. But with that, they're basically going to be tanking the stock market if they are raising interest rates because of the discussions that we had prior, talking about really zombie companies needing that cheap cash flow coming in. This is a chart looking at the basically positive correlation between the CPI, the Consumer Price Index, as well as the effective federal funds rate, which is the interest rates. We see a pretty positive correlation where when we see CPI numbers increase, like we're seeing right here, CPI numbers are increasing prior to kind of like, let's say, the winter or even the summer of last year, where we're not really seeing increasing CPI. We're now increasing our CPI numbers where we're at like 4.1% for the year. So I think that the federal government or the U.S. Talking heads there at the Federal Reserve will increase their effective federal funds rate soon if CPI numbers are going to continue. And that would be the sign that interest rates and inflation is actually kicking in, which would kind of create a red flag for people to kind of make more investments in the commodity space, in my opinion. Looking a little bit at the inflation that the Fed, which is the Federal Reserve, is actually coming out with, they're saying that there's no real inflation yet. We haven't seen the numbers. This would be the 2020 numbers. I believe this is this is annually. So we'll see at the end of the year goes. It would be great to have a quarterly or even a weekly post for their inflation numbers, but as of right now, they think that there is no real inflation, but they are raising interest rates this year, so it could actually come into fruition a little bit later in 2021 where we start to see an uptick. And once we do start to see that uptick, it can increase quite significantly and quite aggressively. For example, 1972 we were at a 3.2% inflation. In 1974, just 2 years after, we were in double digits at 11%. Kind of similar to the 5.7 in 1976, all the way up to 13.5 in 1980. So really things can shift pretty quickly. So positioning yourselves before the massive push would be a really good opportunity here. And talking a little bit more into the history of what happened back in the 70 until the 1980 period, we saw 1970, not a whole lot of inflation in the commodity side of things, but once we started to see a little bit of a push up, they just kept on pushing. We see agricultural raw materials push up around 1972, we see metals push up, we see food prices go up, and this is a sign early on that we are, because you can't really slow it down, right? The Federal Reserve thinks that they can just flip a switch, decrease the velocity of currency. You can't do that. It is, in my opinion, something that is going to carry a lot of momentum forward. And with the age of the internet and the ability for people to understand what's happening, I think this is going to really exacerbate the kind of push for commodities and push for safe haven assets. Hopefully, if you are interested in crypto, you do have some exposure in the more legacy traditional assets for safe havens like gold and silver. We see 1970 gold was under $300, and at its peak at around 1980 it was over $2,000. This is like small cap alt type of gains that we're talking about. In silver, similar type of story. In 1970 you could buy it for less than $10 per ounce, and at the peak of 1980 it was at $100 122. So some pretty unbelievable gains that you can make in precious metals. I think the overall cryptocurrency market is going to be at a similar type of appreciating kind of environment, except even more so because there's more people in the market. It's more accessible. The friction is reduced to a point where basically anyone with internet connection and a little bit of capital can invest in really any project that they deem to be a worthy investment in the cryptocurrency market. And it's just more accepting of really anyone. To be completely honest, I think crypto is just a better way to go, but having some investments and having some exposure in these more traditional safe haven assets wouldn't be a bad thing as well, in my opinion. So we're going to look a little bit into the charts here. First, looking at the price of copper, it went from around, well, this is actually the copper futures. It was at around 450 and it went all the way down to like 340 during the COVID crash, and now it's at 743. So basically from the bottom of the crash, we're up over 100%, which is pretty unbelievable for the price of copper. We're going to be looking at some soybeans. We've already looked at some charts here. So we were consolidating for a while at around $16 to $13, and now it's at $22. Over 50% gain for just soybeans. Same thing for corn. Pretty strong push to the upside, around, let's say, 100% from the low. And this is the ETF for the overall commodities sector. Not a great looking chart for a very long time, but you can kind of pick any ETF you want. But this is a good representation of how aggressively appreciating a lot of the commodities are currently. So if you don't have any exposure in more traditional assets like gold and silver, I think they will do phenomenal as well. One I am particularly looking at is First Majestic. It would be a really good pick in my personal opinion there. Moving on to some actual charts with TA, looking at them, let's first look at some crude oil, and then we'll jump into gold and silver to finalize the video. But we can see crude oil after its dip to negatives for WTI, Western Texas Intermediate crude oil, crude oil. Brent did not go negative, but WTI did. We saw a massive descending wedge formation that is recently just broken out. So I think gas, oil, and anything related to do with it will be increasing. And the potential target for this is huge. It's going to break the previous all-time high that we saw in 2008. The potential target, just in terms of the geometry and the size of this descending wedge, is going to be over $160. Pretty unbelievable per barrel. Right now, it's let's say $70 or $69, and I think as of right now, it just consolidated, just created a nice contraction to start the push for oil. So if you have an electric vehicle, awesome. I might want to be worrying about lithium prices. If you do not, I think the price of oil will be increasing quite substantially in the coming months or coming years, so keep out for that. Next, we're going to be looking at some precious metals here, looking first at gold, and then we'll finally end off the video with some silver. So if we're looking at the weekly chart, we did see that this nice bull flag has completed. A lot of people are speculating that it will consolidate a little bit further, maybe potentially create a reverse head and shoulders, but we do see when we're zooming back to the previous all-time high that we had in 2011, it is pulling back to form a nice solid level of support. Not absolutely perfect, but it's hard to find that much precision when you're looking back such a far time frame, like, basically 10 years. But overall, we do see the bull flag. It has broken to the upside. It does look like we are potentially creating our next surge to the upside. The all-time high is around 2,200 right here, so we still have not hit it, but it does look very promising for gold in the foreseeable future. Something that I'm looking at a little bit more so than gold is actually going to be silver, because we have seen, if we're looking at the previous historical charts, silver does appreciate at a greater rate than gold when we're in a metal bull market, similar to if Ethereum is appreciating at a greater rate than Bitcoin, or most likely in a crypto bull market. Very similar situation. It's going to fall further when it is in a bear market. That's just the volatility. You got to have both sides of it. But when you are in a metal bull market, in my opinion, you want to be looking more so at silver compared to gold. Both are great investments, but silver is going to be a better bang for buck in my personal opinion. So it has bottomed here. So let's take a quick picture here, and then we're going to finalize the video. So we saw a series of lower lows, a nice squeeze. We saw a little bit of a pop, but we got rejected around this $28 range, $27, $28 range. And this is currently the cap for silver. So gold has broken out. So this is, if this is gold, this is the bull flag right here, and it has broken out, but silver has yet to break out of its bottoming formation. So we see a series of lower lows and then a series of higher lows. This is the nice ascending trend line connecting the higher lows. This is a key level of resistance. So you could look at this point as an ascending triangle formation. Once it starts to really break above $28, I think as well when we will really start to run and move to the upside for the price of silver. So that's going to be the video from start to finish. I wanted to keep it very short, quick, with a lot of information, not just for gold and silver. We always talk about crypto, and I think crypto is an extremely lucrative opportunity to be in during this period of time. But it's always good to have a little bit of diversity in legacy assets like precious metals, even taking a look at some copper futures. I think that's going to be a really fruitful investment or trade as well. So hopefully you guys are well positioned and girls are well positioned. If you have any questions, I will be posting this on our YouTube. This is currently live on TikTok right now. Thank you for joining us today, and until next time, have a good one, traders.